So equities look set for their biggest first half of the year fall since 1932, nearly 100 years. They continue to come under substantial pressure from what seems are an endless array of global concerns and issues. Sunil, it's been a tough time for equity investors. I might ask you to give a brief run through of how things stand as we reach the end of June. Things don't look too good.
Well, look, I mean, there's no lying about it. It has been a tricky time for the equity market. So if you look at a global index like the MSCI World, bring it into dollar terms, down a bit over 20% this year, so a bear market. The list of possible culprits is as long as your arm. So Russia, Ukraine, the cost of living, central banks raising interest rates, China's COVID lockdowns. I mean, we'd probably need a longer show to go through all of those. When you look regionally, it has been quite broad-based in the sense that some stock indexes look as though they've done a bit better, but then when you adjust for their currencies, they're kind of all in line. Maybe the only outlier is the UK, which is probably only down about 10 to 12% in dollar terms, and actually in the local index, it's pretty flat this year.
Okay, so that's an interesting one. So with all the carnage that's happening across the globe that you've just mentioned, UK produced a pretty much flat return. How is that possible? What's driven that?
Well, the weakness of the currency, so sterling has probably dropped about 12% this year against the dollar. That has helped because if you've got internationally based companies but reporting back in the UK, then the sterling value of their profits does look a bit better. But also the UK does have an interesting kind of makeup of sectors and industries. So it's quite heavy in commodity producers, like a BP in the energy sector, but also some quite defensive names like GSK in healthcare or Unilever in terms of consumer staples, not too dependent on the economy. And perhaps most importantly, not too many big tech companies because they've been hit pretty heavily this year.
Okay, so my take on the past number of years is that and I shouldn't say this possibly, it didn't take a genius to generate returns. The whole market has just been rising. But what's interesting now, and you've just kind of briefly touched on it, is that we're kind of seeing a decoupling where different sectors and regions are performing very differently from one another. So what sectors have worked and what sectors haven't worked over the last couple of months?
Well, I'll get over my feeling of hurt that you're not calling me a genius, but you're right, in a sense. It has been a rising tide lifting all boats. And if we look this year, some real differentiation. Energy, no surprise, has been the standout performer so far this year. It's up over 20% in dollar terms. The rise in the oil and gas prices obviously supporting, but also it started from quite low valuations. On the other hand, tech, the hardest hit. I mean, global IT is down about 30% this year. Valuations were much higher and a lot of optimism about future growth, which had driven really big gains in recent years.
Okay, so for you, how do you, as a portfolio manager, position your portfolio in this type of environment? Is it just a question of sort of hiding in the cheapest stocks?
Well, valuations do matter. I mean, if investors become a bit more concerned about the long term, they're just not going to want to pay up as much for owning shares. But I think actually a real theme this year has been the shift from concerns about valuation as rates rise to more of a concern about economic activity and company profits. So I think investors are really seriously debating recession risks. If you take a sector like basic resources, which includes the mining industry, it was actually pretty flat to the beginning of June, but now it's down over 15%, and that's really that transition from valuation to economics. Now, in terms of where we go from here, I don't think we're out of the woods yet. The analysts who publish their forecast for companies haven't really started to publish lower numbers, and I think until that process starts, investors are going to be a bit cautious and a bit reticent. But against that, the silver lining is we don't actually think that a worldwide recession is the right forecast to have. I mean, we are going to see tough times for some regions, maybe close to home in terms of Europe. But globally, we think there's going to be some support for some companies. We're seeing some value opportunities in places where earnings might have a bit of support, even if the economy is slowing. So we talked about the UK or the energy sector, but also areas like the banking sector, which benefits from higher interest rates, healthcare, which has got tailwinds from demographics and innovation. These are areas that don't just depend on a booming economy or cheap money.
Okay, so it sounds like the worry now is kind of around earnings and recession risk, and possibly those worries might be sort of getting ahead of themselves a little. Sunil, always really interesting to catch up with you. Thank you so much, and we will see you all again next week when we talk about another topic that's caught our eye.